In this video, I'm going to talk about the GAAP principles. So you're given, in this case, this is the DBE November 2018 paper for grade 10. So what they've given you here, they said a debtor who owes 1270 was written off as a bad debt as he could not be traced. And then you are given the choices here: materiality, business entity, matching, and prudence. Okay, now, so in this case, the answer for number 1 is going to be the prudence concept. Remember, according to the prudence concept, we are saying the business must record its financial records as in the most conservative way possible. So in this case, the fact that the data cannot be traced automatically means we cannot keep hoping that we're going to get money from this data. This income that we're supposed to get from this data cannot be obtained anymore because this data cannot be traced. So in other words, in order to apply the principle of prudence, in order to be conservative, we have to apply the principle of prudence, which means we are saying in the meantime, we are not going to recover this money. If by chance we do recover it, that's a bonus. But the bottom line is that this money cannot be recovered because we cannot trace the data. Therefore, we apply the principle of prudence, which means we are being conservative. Okay, then number 2 says interest on overdraft is not shown as part of bank charges. Now, you need to understand that interest on overdraft is interest expense. In other words, it is a result of borrowing. You have used money that does not belong to you. But bank charges is an expense, but this type of expense is what the bank levies on your account for them to manage your account for you. So these expenses, both of them are expenses, but they are coming from two different scenarios. Interest on bank overdraft is a result of borrowing, which could be taken as financing, and then bank charges are taken as a way of as a payment for the bank running or operating your account, which is an operating expense. So interest on overdraft is a financing expense. Then the bank charges is an operating expense. What that means is that you applying the principle of materiality. So this one is going to be materiality. What does the principle say? The principle says items that have an impact on decision making must be shown separately. Now, why should this be shown separately? One is an expense resulting from borrowing. Then the other one is an expense resulting from the operation of a bank account. So the answer is going to be A for 1.2. Then number 3, an amount of 450 still due to the telephone for the telephone at the end of the financial year will be added to the telephone expense in the income statement for the current year. Why? Even though it hasn't been paid, this amount relates to the current financial year. So this is going to be the principle of matching. So this one is the principle of matching. In other words, expenses and income relating to a specific accounting period must be recorded in the same accounting period. So this is 1.1.3. Okay, and then the last one, the owner pays her own personal cell phone account with a business check. She does not record the amount as an expense to the business. Now, why? Here you are now applying the business entity principle, right? Is the business entity principle, which is this one. So this is 1.1.4. So this is the business entity principle, because we are saying the business entity principle simply says the financial records of the business must be shown separately from the financial records of the owner. That is how you get these 4 marks that we allocated for this question.